highlighting our best of Bloomberg Intelligence. Gina Martin-Adams, Chief Equity Strategist of Bloomberg Intelligence. And of course, as Taylor does in, day out, she sets us up perfectly for what you have already been assessing. Are we looking a little bit rosier? Are we getting more Coca-Colas at the moment managed to meet and raise rather than those that are under fulfilling or already low bar?
Yeah, I think it's very, very mixed results at best, Caroline. It's a really interesting earnings season for a lot of reasons. One of those is when we blend the results, we take the results of the companies that have actually produced earnings results, and then we blend those with the estimates for companies yet to report. We actually only see a marginal beat. So even though more than 70% of companies that have reported earnings, of the 100 and so odd companies that have reported, they've beat expectations, but analysts are still really rapidly marking down the forecasts for companies yet to report. And the result of that is only a tiny beat to third quarter earnings season thus far. Likewise, when we look at the outlook, every single quarter all the way through fourth quarter of next year is showing downward estimate revision momentum. So this is a season that really is characterized by the degree of analyst capitulation, I'd say, more than anything. The other thing that I'd highlight, which I think is this sort of misnomer that's going around the market right now, is that earnings are being celebrated. As a matter of fact, when you really dig into the price reactions of the companies that report earnings on the day that they report earnings, they have a negative price response. So the companies that are reporting earnings beats are on average and on negative, producing a negative relative on median, producing a negative relative excess return to the S&P 500. So there is no reward for beating coming out of this earnings season.
Yeah, and I think we're starting to see that. Is there going to sort of be, I guess, a separate sort of category, a separate standard for some of the really mega cap companies, Microsoft, Alphabet, tonight after the bell? Of course, a little bit later, we're going to get, Amazons and Apples and those types of companies. Do they get more of a pass?
I don't think so, Romaine. I mean, I think if anything, they are held to a higher standard. They have higher on median and on average valuations than the rest of the S&P 500. Their expectations for forward earnings growth are much faster. Their expectations for current quarter are very low, so they should be able to beat those expectations. But if you think valuations are at all meaningful, valuations for this group is roughly 50% above the rest of the S&P 500. That would imply that the expectations for this group going forward are for a pretty significant improvement in that really negative earnings landscape that most analysts are expecting to emerge. Will that happen is a huge question mark. If these companies can come to the table and indeed justify analyst expectations going into 2023, they very well could perform quite well. But it's a tough call right now, particularly amidst this macro environment, which has very limited visibility.
Gina, of course, we're getting a lot of comments about dollar strength. You've been out front and center on that. We're also getting a lot of comments about free cash flow with I believe GE, of course, a little bit to the positive side, but then you get Xerox comments a little bit to the downside. How are you thinking about free cash flow in this environment?
Yeah, so we've noted for a couple of consecutive quarters now a growing number of companies with declining free cash flow on the S&P 500. I think that is a persistent problem that is only growing, as naturally you would expect. The economy has, in a technical sense, been in recession since the beginning of the year. Companies are indeed confirming that with these free cash flow front trends, at least relative to a year ago, sort of suffering. Now, it's not indexed at large because you obviously have some pretty big cash generators in the index that are masking this underlying weakness. But for several quarters now, we are seeing the weakness grow and spread across the index.